Talk to Ashish Shah right now, Chief Investment Officer of Public Investing at Goldman Sachs Asset Management. Good morning to you. We saw the CPI number yesterday. We're all really waiting for what Jay Powell is going to say on September 18th. So maybe you can give us a little bit of a prediction about what it may be, but maybe what you would do about it in advance.
I got to tell you, I'm so excited because it's very rare that you get to see an easing cycle begin. And we're about to do this. So next week, we're going to start the easing cycle. It's going to continue for a while. We don't know how many total cuts we're going to get. The Fed's going to have to feel that out. But I think what's important is not to focus about kind of the next week's information, but it's really setting up the playbook for this entire cutting cycle. And there's a lot of opportunity out there. But, by the way, I'm really concerned that people are hanging back. They're facing this uncertainty around this election, and they're going to miss the opportunity to lock in yield, to lock in returns in the equity market if they don't pay attention.
Okay, so when you say you're worried people are going to miss this opportunity, why don't you spell out the opportunity as you see it in terms of what people could actually be doing then?
Okay, so let's start in the equity market because that's where the big returns are going to come. We all have been focused on the largest cap companies, the AI companies, and passive kind of S&P. You go into a cutting cycle, most of this interest that's being paid by companies is actually being paid by smaller cap companies, right? Those are the ones that have floating rate loans. They're going to be the primary beneficiaries in the corporate space of rate cuts. And you want to be investing in those small caps, but you got to focus on the quality. And so, when I think about small caps, it's going to represent a meaningful opportunity. You look around the corner, January, the best month for small caps is coming up. And on top of those things, I think the second half of the year, you're going to start an IPO market, which is going to create opportunity, and M&A and LBOs. And that's really critical to this space because that shrinks the space on the LBO side. It brings new growth to the space, and that new growth is going to be high quality because investors are going to be discerning this time.
But Ashish, are you suggesting go buy the Russell 2000? Are you suggesting there's certain ETFs you buy, or you're saying you have to be buying individual equities?
Yeah, so I think the tough thing about buying the Russell 2000 is there is a lot of poor quality, as we've seen, meme stocks and other things. So, obviously I'm biased, but I prefer our ETF in the space, GSC. And that's where we really focus on quality companies that are both growers as well as represent value. But I do think you can take any really high quality small cap active strategy, and that's going to perform over the course of the next 6 to 12 months.
And what would you do with the Magnificent Seven or even the S&P 500 if you were there right now?
Look, I would do exactly what everyone in the market's been doing. You see one of the biggest withdrawals, one of the biggest outflows of large caps over the course of the last month or two. And that is because people have really gotten overweight those large caps, whether it's global investors, whether it's U.S. investors. If you had passive allocation, you've gotten overweight this space, and it's time to diversify your equity portfolio. But by the way, there's also going to be opportunities on the fixed income side.